Welcome, everyone. My name is Christian Fock. I'm the chair of the board of ASFI. I'd just like to start off with a welcome to country. We meet in parts of country where elders of the local Aboriginal community have been custodians for many centuries. We acknowledge their living culture and their unique role in the life of these regions. I'd like to acknowledge we hold our meeting on traditional lands and pay my respects to elders past, present and emerging. So thank you everyone for joining. This is a really exciting session. So I'd like to welcome you and also thank all of our panellists in both Australia and Europe. Welcome to all the attendees. We do have about 200 people that are registered, and I know that people are still sort of progressively logging on, so hopefully we'll be able to capture most of those registrants. If you know people that aren't able to attend, we are recording this session and it will be edited to make it reasonably watchable in terms of content, so people can access this following the session. So today's session is brought to you through a collaboration between ASFI and Climate Kick with the support of the EU Climate Business Network and funding from the European Union. For those of you who are not familiar with the Australian Sustainable Finance Institute, ASFI is a newly established organisation founded off the back of a collaborative effort across the Australian financial sector to develop the Sustainable Finance Roadmap, which was released 12 months ago. The intent of the roadmap is to better align the financial system to support a more resilient, sustainable and prosperous future for all Australians. The roadmap includes recommendations under 4 domains: embedding sustainability into leadership, integrating sustainability into practice, enabling resilience for all Australians, and building sustainable finance markets. We have 21 founding members of ASFI from superannuation, asset managers, banking, insurance and the broader finance sector who are supporting ASFI and the work that we're doing in beginning the implementation of this roadmap. Our members see the roadmap as a critical contributor to a more sustainable and inclusive Australia, with ASFI driving and coordinating its implementation by working collaboratively right across the finance sector. It is my pleasure to introduce our moderator for the session today, Nadia Daly. Nadia is a journalist with the ABC 7:30 and is based in Melbourne. She has worked for the ABC in Sydney and Darwin and in Hong Kong, France and Canberra, and in print and television journalism. So over to you, Nadia.
Well, thank you very much, Christian, and a big welcome to everyone to what I know will be a very lively, engaging and very useful discussion for everyone attending. So thank you all so much to everyone who's joining here in Australia or overseas. So, as we just heard, we're about to hear from a wide range of perspectives on COP26, what it means for the Australian financial and business sector, and from what is, a very experienced and knowledgeable panel right at the forefront of these issues. That really struck me when I was looking at the panel of guests we have tonight. A really impressive lineup. And we're going to dig deeper for all of you in the audience, going behind the headlines, so to speak, looking at what Australia can learn from these big global developments over the past few weeks. And my hope is really that everyone can leave tonight's event with some practical knowledge as well that you can put to use. Now, if you have any questions, I would encourage you to type them into the chat as the session progresses. There'll be some opportunities to put those to the panelists after the two sessions. Now, before we begin our panel session, we're joined by Dr. Alex Heath, the Head of International Department at the Reserve Bank of Australia. She's held senior management positions in the economics and financial markets groups, and her current role includes supporting the Reserve Bank's involvement in the Network for Greening the Financial System and the Council of Financial Regulators' work in climate change. So welcome, Alex. Thank you for your time and insights, and I'll hand over and let you kick things off for us.
Thank you so much, Nadia. Good afternoon to everybody who's on the call. It's really a great pleasure to be here to help kick this event off. Nadia's already explained that the purpose of this event is to take stock of the developments around COP26, but perhaps more importantly, I see this as an opportunity to really start the conversation about what concrete actions come next to keep that momentum going. As a participant in the Council of Financial Regulators, I think that the financial regulators have a really important role to play in that conversation, and there are a number of us participating today. As financial regulators, what we're aiming to do is fulfil our mandates for financial stability by finding ways to help markets and investors obtain the information that they need to price climate risks and opportunities effectively. In doing this, we're also going to be supporting a much broader range of policies that are going to be put in place and are required for this country to meet its climate commitments. The process of price discovery and managing risk is particularly complicated in the climate sustainability space for a number of reasons. So the first one is that history is not a good guide to the future. So we can't just use the tools that we typically use to think about financial risks off the shelf and apply it to the climate change question. So there is a bit of a question about, well, what are the right tools to be taking on that task? Another reason is that there is a lot of uncertainty in this space. So there's uncertainty about exactly how the direct effects of climate change will play out and how transition risk coming from decisions about policies, changes in technology, changes in behaviour, how those transition risks are likely to evolve. And those uncertainties just sort of compound the longer you look at the horizon that you're looking over. And we know that for climate change, we're really talking about thinking in terms of decades, if not hundreds of years, rather than just 1 or 2 years, which perhaps some other analysis might focus on. I think another complication for us is that our understanding of what the problems are and what the solutions are is also constantly evolving. So in the process of sorting through these issues, new information is coming to light all the time. So the question for financial regulators is, what could we do and what should we do to enable this process? In the context of Australia, that question is really addressed by the Council of Financial Regulators Working Group on Climate Change. And that's a group that has representatives from APRA, ASIC, the Reserve Bank of Australia, and the Treasury. Domestically, the CFR agencies are regularly talking with investors, financial institutions, non-financial institutions, and industry groups to understand what they think would help them and enable their efforts to manage their climate-related risks and investments effectively. ASFI and Climate Kick are a really important part of that ecosystem, and it's great to see so many other people on the call that we've spoken to on numerous occasions over the past couple of years. Having said that, we recognise as regulators that we're not operating in isolation, and international context is incredibly important. There's a lot of reasons for this. Some of the more obvious ones are that climate change is a global problem, and financial regulators everywhere are trying to get to grips with the answers to the questions of what they could and what they should be doing. Also, very importantly, financial markets are global. So this is another channel through which the international developments can affect domestic markets and companies. International developments include regulatory changes that are designed to support the transition to net zero in other jurisdictions, but it also includes things like shifts in portfolios that are related to investors making decisions about how they're going to manage their climate risk. Taking this into account, domestic regulators talk regularly and directly with our overseas counterparts. We also participate in a whole range of international groups to learn from others and hopefully to contribute where we can. I often say that there's really no international engagement these days where the topic of climate change doesn't come up in some form or another. So this event is another excellent opportunity to understand the international developments and their impact on or potential impact for Australia. And that in turn will help to inform the question of what financial regulators here should be thinking about. So just very quickly to give you a flavour of what's on the agenda, it's all summarised in what we call the stock take paper, which is available on the CFR website. But it outlines the four main priorities that the CFR working group has, well, at least over the next year. And I'm pretty confident a lot of these topics are going to come up in the panel discussions that we're about to have. So the first priority is regulatory guidance. A consistent message that we have heard in our discussions is that market participants really want very clear regulatory signals. That sounds entirely reasonable, and to this end, ASIC and APRA have both issued regulatory guidance, particularly around the management of climate risk. The second priority is around scenario analysis. I mentioned that we need different tools. Scenario analysis is one of those tools. That's really been spearheaded by APRA, who has embarked on what we're calling the climate vulnerability assessment with Australia's 5 largest banks. It takes into account, it takes 2 of the scenarios from the NGFS work to look at the effects of physical and transition risk on bank balance sheets. I think one of the things that we have learned is that we can take the narrative from the NGFS scenarios, but there's still quite a bit of work to do to make those scenarios fit for purpose for this exercise in the Australian context. So in particular, it's really important to have granular geographic data to be able to look at physical risks and the impact on property prices. It's really important to have quite a granular idea of what sort of structural change and industrial change you might expect under each of these scenarios so that you can look at the exposures related to the business book. One of the things that we have also spent a lot of time thinking about is the macroeconomic overlay, or the second round effects on banks' balance sheets once the direct effects are aggregated up. So for example, conditions in the overall labour market as a result of climate-related structural change could have an effect on asset values or the ability of people to repay their loans above and beyond the sorts of effects that you would find if you're just looking at a very specific firm. And in talking to companies and financial institutions, we have actually heard that coming up with these coherent scenarios that include the second round effects or the macroeconomic overlay can be quite challenging. So we are hoping that some of the efforts we're going to for the CVA will have broader application. So the CVA, as I mentioned, is in train. Hopefully the results will be available in 2022. I would just like to note that the success of this exercise really has had a lot to do with collaboration. Both the RBA and APRA participate in the NGFS work streams that have focused on developing these scenarios, and that's been an invaluable opportunity to learn from others. APRA has also worked really closely with the participating banks and the ABA during the design phase of the CVA, and I think that's going to be really important foundation for its success. The third priority is disclosure. So I think the case for consistent high quality disclosure is pretty clear cut, so I won't go into that. But really the question as it stands is, what do we do from here? The CFR agencies have all said that we support the TCFD, and interestingly, investor pressure for better disclosures has already been an important driver of the increase in the quality and the coverage of climate-related disclosures in Australia. As people who are following COP26 closely would already know, there were quite a few developments on the disclosure front at COP26, most obviously with the creation of the ASFI, which is hoping to publish a draft standard for discussion, for consultation, in 2022. So they're going to get to work pretty quickly. There's also quite a lot of anticipation about what the SEC in the United States might announce in early 2022. The CFR agencies, and in particular ASIC, are watching these events really closely, and the question about what additional steps would be helpful in this space are at the top of our working agenda. The final priority I just wanted to briefly talk about was taxonomies. As with disclosures, there's a lot going on in this space, although I think it's fair to say that things are not very settled. So there's quite a few detailed taxonomies available, in particular the EU taxonomy. And the international discussion has really highlighted that many countries require taxonomies that put more emphasis on things like defining the transition paths that are available to be able to say that a taxonomy is relevant to their own jurisdiction. So at this point, I'm not sure how, it isn't very clear how that tension between having a common set of definitions versus having a set of definitions that suits a particular jurisdiction will be resolved. But I think it is pretty clear that standing back and waiting for these issues to resolve before acting is not really an option. Working towards an Australian taxonomy is high on the list of priorities, and for the CFR, but also if you look at the ASFI roadmap, it's one of the areas that they want to put quite a bit of priority on in the very near future. So forums such as this one are a really important part of opening the lines of communication and building new relationships that will help us make progress on these priorities. And I really look forward to hearing what our panellists say and what our participants have to say over the next hour or so, and hopefully will help us make some progress in the very near future. So thanks for listening, and I will pass back to Nadia.
Well, thank you so much, Alex. That was so valuable to get that real overview and some interesting insider insights as well from your position. And I know that will be so valuable for everyone here today listening in the audience. And I can already see we've got quite a few questions from people. So everyone's obviously very engaged. And we'll come to those questions later, but for now, we'll go straight into our panel discussions. So we've heard a lot about the outcomes of COP26, the fact that countries couldn't yet meet the level of ambition needed to reach 1.5 degrees, the fact there's still more finance needed to support climate action and adaptation and adaptation rather, and that coal will be phased down, not phased out. But tonight or today, for those joining from Europe, we're going to go beyond the headlines and unpack what Glasgow means for Australian business and finance. 2 points stand out. We saw the biggest ever turnout from business and investors at a COP this year, as the Glasgow Financial Alliance, the net zero, pledged $130 trillion of private capital towards the economic transformation required for net zero. We also saw the US and China come together with a strong signal that their relationship on climate would be cooperative rather than competitive, which is obviously a very welcome sign for everyone. So I'm excited now to introduce our first specialist panel to you all. They'll help us to unpack some of what transpired at Glasgow and what that means for the Australian financial ecosystem. So I'll introduce everyone. First of all, I'm joined by Louise Cantillon, the British Consul General and Deputy Trade Commissioner at the British High Commission; Jamie Isbister, the Ambassador for the Environment and Head of Delegation to COP, the Department of Foreign Affairs and Trade; and Paulina Demirkak, the Director for General Affairs, Directorate General for Financial Stability, Financial Services and Capital Markets, the European Commission. Now we might start with Louise and take a bit of a bird's eye view of the summit before we get further into it. First of all, what in your view were some of the key outcomes from COP26 that people might not have heard of in the headlines?
Good afternoon, everybody, and hello, and thanks, Nadia, for the question. So I think you just mentioned or referred to it really, that it was a huge attendance in Glasgow, and it was actually the biggest conference that the UK has ever held, with 50,000 attendees and 121 business country leaders attended. And if you think that against the backdrop of pandemic still being around in the world, it was a massive undertaking and hugely logistically challenging. So a lot of my colleagues all over the world worked with teams in their individual countries to get them to the event. So I just wanted to sort of pay homage to all those people who actually made it happen. And then a few other little snippets which are not directly financial related, but I thought they were quite interesting, is that as you know, the summit was held in Glasgow, and we actually made a new whiskey for COP26, which was made from 26 different distilleries in Scotland and was only given to world leaders. And I've really tried to source a bottle myself, but have not been able to. So if you know any world leader that's giving theirs away, let me know. But first of all, let's just take a look at what the main outcomes are. And we've seen over 90% now of the world's economy is covered by a net zero goal, which is up 30% from 2 years ago. So a real move in the right direction there. That includes 18 countries in the G20. 190 countries and subnational governments have now agreed to phase out coal power or end support for new coal power, with £18 billion in funding to help support that transition. We have seen ending in international finance for unabated fossil fuels, which is really building momentum, and 34 countries have committed to end that by 2022, which could mean over £36 billion of investment redirected to green energy. In terms of, we saw big announcements on deforestation, with 141 leaders that represent over 91% of the world's forests have pledged to end deforestation by 2030. And then on methane was another area where we saw a lot of progression, with over 100 countries responsible for over half methane emissions have joined a global methane pledge to cut methane emissions by 30% by 2030. And you mentioned yourself, Nadia, $130 trillion of private finance is now committed to net zero targets and setting credible 1.5 aligned near-term milestones. Alex referred to the ISSB, the new International Sustainability Support Board has now got support from 36 different countries and will develop a comprehensive global sustainability reporting standards that will have robust governance and oversight. So the next step really is to see how these things move into action, into doing in the rest of our current decade. Thank you.
Loved the detail about the whiskey. We'll have to try and source some of that for you. Now I wanted to ask you about the US-China declaration to cooperate on climate. Obviously, that was one of the big sort of announcements that came out of COP. How important was that?
So as you said, it's really, really welcome. They are two of the world's largest emitters, and for them to focus on near-term emissions reduction is a really great positive move forward. And a real focus of COP26 for us was to increase that ambition, but also to increase action in the sort of 2020s. This was reflected in the Glasgow Leaders Pact, which was signed or agreed then, which hopes to see countries to ratchet up their commitments by COP27, which will be held in Egypt. So we just need to see what concrete steps will be taken now, as China has also, agreed a commitment to accelerate coal phase down and address their methane issue. So we'll have to watch the outcomes of that. And then, under the UK COP presidency, all 197 parties agreed on the climate pact to keep 1.5% alive and finalise the outstanding elements of the Paris Agreement. And one thing to note actually is that around fossil fuels, phase down of unabated coal power and inefficient fossil fuel subsidies, as well as mid-century net zero text, this was incorporated into UN agreements, and it's the first time that we've seen this language ever used before. So we see that as a really great progression. Yes, and then, as I said, we'll need to see what action happens now in the 2020s. But any alignment or working together on this is very positive from our perspective.
Yeah, indeed. Obviously, so valuable for us to have you here on the panel. In your position as Consul General. So I might ask a question more specific to your role. The way that COP26 drove momentum around sustainable finance was very impressive. How did the UK as hosts encourage this acceleration, and are these, is that translatable outside of the COP environment in your perspective, and what insights might you have around that?
I think it is, because it has been a foreign policy priority for us this year and previously, and so we have worked really closely with quite a number of the other panel members. We've had some engagement and dialogue for the past few years, but with all areas, with civil society, with governments, and with businesses. And it is a topic that is a real high priority for us, and we'll continue on that. But we have got that backed up by some sort of regulatory encouragements, also some statements or some plans. For example, the government published our first green finance strategy in 2019. So we were thinking about this well before COP26, because this is a huge opportunity for the UK, with London being a hub of financial services. And we want to drive that growth of sustainable finance. And it's also about mainstreaming it into sort of all our policies. So, for example, we've released an atlas to green investment in the UK. We've also released a roadmap to sustainable investing. We ensured that sustainable finance is always central to all our discussions. And then in November, during the World Leaders Summit at COP, we announced that the UK will be the world's first net zero aligned financial centre. And this means making publication of transition plans mandatory for the next iteration of our UK finance strategy. So the strategy and regulation is streamlined into everything we do, and that's something that I need to work with overseas, but it's integral to delivering our work.
Yeah, interesting. That seems to be key with all of this is streamlining into everyday processes of government and business. Yeah, lovely to hear from you. I might speak to Jamie now, and Jamie, wonderful to have you with us with your experience in this field. Interested first of all to hear from in your perspective on the key outcomes of COP. A significant achievement was the establishment of an international carbon trading framework. What opportunities does this open up for carbon markets and investors in the region?
Thanks a lot, Nadia, and good to be on the panel with Louise and Paulina. Louise, I understand there was 900 bottles of that scotch produced, so it's 121 litres, so there's 779 bottles missing somewhere, so you might want to track them down somewhere.
You were there, weren't you, Jamie? Did you?
I was there. Unfortunately, I didn't get one of those bottles.
Didn't you?
But look, very fair question, Nadia. Look, just very quickly, the one I just want to acknowledge, the work of the UK and the holding of the COP. I think, as Louise said, it came at a really challenging time. There was a lot of work leading up to all of it, and I think for something that's trying to drive all countries to come together to deliver a greater ambition on climate, it was a really important and fantastic outcome. I think there's two key elements to the COP from my perspective. One of them was the negotiations and finalising the rule book, and I'll touch on your point about markets in a second. And the second element is a lot what Louise has talked about in terms of the commitments, action, implementation agenda. And I think this is a space that particularly a lot of those on the call are going to be interested in, is how does some of the commitments coming out of Glasgow mean in relation to what governments, industry, civil society are going to need to do to deliver on the practical ambition of COP. Look, just on the negotiations, I mean, for those who are less familiar, I mean, the Paris Agreement was obviously agreed back in 2015. And since then, the focus has been finalising the Paris Rulebook, which really determines how do we countries agree to the ways they can deliver on the key elements of the agreement. And one of the key outstanding parts was agreeing rules for how we would trade international carbon offsets. So how companies would trade carbon between borders across countries. And there's the mechanism that people would be familiar on that was established under the Kyoto period, the clean development mechanism. But this was really trying to look at rules that could provide confidence that trading was going to drive high integrity outcomes for environmental outcomes and was going to deliver real abatement. And the reason this is so critical is because so many countries' commitments on their NDCs are actually going to be dependent on markets. There's a lot of countries that have said the way they are going to have to meet their 2030 or even their 2050 net zero commitment is going to be by purchasing offsets and being part of an international carbon trading mechanism. And it's obviously critical for a lot of private sector companies because businesses are going to need a market mechanism for them to be able to meet their own commitments that they've made to shareholders and investors. So getting those agreed was really critical. It provides a framework now for how countries are going to move forward and confidently develop arrangements. It was key to avoid double counting so that there wouldn't be, when people are purchasing a ton of carbon, that it's not going to be counted twice by countries or businesses, that it was going to be able to provide confidence on the verification and monitoring of that, and also that there was agreement about what sort of contribution, mandatory or voluntary, might be included as part of the payment of an offset. Just to finish, the reason this is also key is because, particularly in our region, the Indo-Pacific region and particularly Southeast Asia is seen as a region that is going to be key in providing offsets. Australia announced 6 months ago that we would establish the Indo-Pacific carbon crediting scheme, which was going to be about how we work with countries to develop the systems for them to be able to participate in those market mechanisms. And I know for a lot of Australian businesses, being able to have that mechanism that they can purchase with confidence offsets is going to be a key thing in the longer term. But look, I'll stop there, Nadia. There's a lot more obviously on the markets agenda that could be talked through. I know a lot of people have got a lot of interest and background on this, but I'll stop there and happy to take any other questions. Thanks.
Yeah, well, thank you so much. Really interesting, and I think those sort of insights of why people are here tonight joining us to hear the implications of COP for the sectors here in Australia. In addition to the negotiations, Australia's also announced a number of new international partnerships at COP. Can you provide us with some more detail on these and explain how Australia will work with its regional partners and what implications this will have for business and investors?
Yeah, look, thanks, Nadia. I mean, obviously, as Louise and others know, have highlighted and people know, Glasgow was very focused around ambition and around that ambition being reflected through targets. Australia took as you know, a commitment to get to 2050 net, to a target to agree to get to 2050 net zero. There was pressure and expectations, and there'll continue to be for countries, including Australia, to continue to look at what more it can be doing over the next decade. We know that's going to be critical to being able to keep the 1.5 degree temperature goal within reach. But one of the key elements on this was how do we actually deliver on that ambition in a very practical way? And one of the key things here is how do we drive the new investments, the trade and investment frameworks that are going to drive a transition to a clean energy future? How are we going to work with countries like India, Indonesia, Vietnam, Korea, Japan, who are currently dependent upon fossil fuels to a large extent for their energy? How are we going to work to be able to accelerate that transition to a clean energy future? And so the government's announced a number of new commitments, both regionally and bilaterally. The government announced a green economy partnership with Singapore to how we would work together to be accelerating investment in the research, in the investor cycle to be able to accelerate the uptake in renewables, in clean hydrogen, in green steel, green aluminium. Equally, partnerships with India, Indonesia, and Vietnam. Countries who, if they're going to be able to transition to a cleaner future, is going to need to have those access to those products and clean fuels. That's going to be key. We know that Australian private sector is moving very fast on this. People would hear what's been happening with Fortescue Futures, with Sun Cable, with a range of other companies that are now not only investing in the transition of Australia's clean energy move, but also how we become an exporter of clean energy through electrons, through the production of green hydrogen, through green ammonia, which are all going to be key for that regional transition. So a lot of the commitments the government's announced and is going to be sort of building on in the coming years is putting what I would describe the railway tracks in place for the investment and private sector to be able to then drive that whole transition to a clean energy future. One of the key things that the government's also going to be doing in the first 6 months of next year is the Prime Minister announced a global clean energy supply chain summit that looks at how do we get the supply chains in place to be able to really accelerate those investments. Australia provides 54% of the world's lithium. How do we ensure that production of lithium, the critical minerals, are going to be key, are going to be able to move in a way where we're reducing the tariffs, the barriers and the constraints that can come with that. There's other things we could talk on about standards, clean energy standards that are going to need to be worked through to give confidence around how the trading and investment in clean products can happen in a transparent and confident way. But again, with Nadia, with time, I'll stop there, and again, happy to respond to any questions people may have.
Yeah, thank you so much, Jamie. Keep talking about it for a while longer, I'm sure, but we'll definitely come to some questions from the audience at the end of this panel, so I'm sure there'll be more to hear there. Yeah, some hot tips there for countries and sectors to watch in the wake of COP, which I'm sure everyone found very valuable. We're also lucky to be joined by Paulina Demek-Hack from the European Commission, so great to have you with us. If I could start asking you, Paulina, to sort of go back and broaden things out a bit, and I also glean some things that Australia can learn from the EU. Interested in looking at the EU experience around sustainable finance. Europe has really been a global leader on sustainable finance and setting strong regulatory standards through the EU taxonomy, more recently establishing the European Green Bond Standards and its new sustainable finance strategy. First of all, I guess broadly, what can we learn in Australia from the EU experience here? We've obviously heard a bit of this already from our panelists, but from your perspective, what might we learn from the EU?
Thank you, Nadia, and good evening to everyone. Good morning to Europe. I'm absolutely delighted to join you, and I hope I can share a little bit the EU experience, and I will actually also loop back to some of the issues that other colleagues have mentioned. I think for us, the whole sustainable finance piece is very much a journey. It's a process. I think the good news is that the European Union has made a lot of progress. The bad news is, of course, we are running out of time. The world is running out of time. Now, what we have been doing, we actually started this work back in 2016 by putting in place a high-level expert group. And building on the work of that group, we had an action plan on sustainable finance back in 2018. And it has 3 building blocks, and I'm mentioning them because they keep coming back in the debate still today, and it's still, I think, very much the basis of everything we do. And the first one is disclosure. Alex mentioned that already. I think she's right that has got mainstream. Everyone agrees that we need the transparency, the climate reporting, the disclosures. The second element, which I think is still a little bit more controversial, is the taxonomy. In Europe, we are absolutely convinced that we need a common classification system. And the reason why this is so important is to avoid greenwashing. Because everyone is today going green and sustainable, but if we don't have some kind of collective standards, it's going to be very, very difficult to actually, for investors to assess whether things are really green or not. And the reason why this is so important is obviously that we want to make sure that we channel investments into green and sustainable projects. So that's the number 2. And then the number 3, and it's mentioned also, been mentioned already, it's the green labels and the, for example, the green bonds. European Union is, as you know, a big green bond issuer. The UK, by the way, has also issued very successfully green bonds recently. And these, we think all these 3 elements together provide a very good basis. Now, however, that's not enough. And I think we realized ourselves that we need to build on what we already had in place. That's what I think this really is a process where we are ourselves also learning along the way. And what we did this summer, back in July, was that we put forward our renewed sustainable finance strategy. And it has 4 elements, and obviously building on what I was already mentioning. The first element there, and Jamie mentioned it, and I think Louise mentioned it as well, and that's a transition. Because we know where we have to go in terms of climate neutrality 2050. We have also in Europe, as you know, taken the commitment to reduce by 55% our greenhouse gas emissions by 2030. But we need to get there, and we need to finance that transition. And in that context, we are looking, for example, at gas and nuclear, and that's work that is really ongoing as we speak. So the transition is important. We cannot jump from today to tomorrow to a completely climate neutral world, much as we would want to. So that's important. The second point, that's something that Alex mentioned, and that is the resilience of the financial sector. And what we are looking at in that context, and obviously the central bank is doing a lot of work there in terms of scenario planning, in terms of climate stress test on banks. But what we have been looking at is how to integrate ESG considerations in the risk management of banks and insurance companies. And we have actually put forward legislation to that end in Europe very recently. So that's the second point. The third point, and that is, I personally think, a very important one, and that is the fair transition, the inclusion, making sure that this actually works for the entire society. We need, obviously, the big companies to come along, but we also need SMEs, and we also need citizens, and that's why the focus on the inclusive transition, I think, is a very important one. And then fourthly and lastly, and I will conclude on that note, is the international cooperation. And that is something that I think everyone on this panel has already alluded to. COP26, of course, a very important moment, and others have covered that extensively already. We need the international cooperation here to continue. I think the good news is that now, and Alex mentioned that, climate change, sustainable finance, I think it comes up in every international gathering, be it G20, be it G7, be it the Financial Stability Board. We have ourselves in the European Union, our international platform for sustainable finance, which, by the way, the UK is a member of, and which is a very good body to exchange best practices. I think this work is really, really crucial. Not everyone will do the same, that's very clear, but what we need to achieve is at least some kind of level of consensus and coherence, and some interoperability between the different standards. I think Europe will continue to want to go further, to want sometimes to go faster than others, but this level of a baseline, if you wish, and ensuring interoperability, that I think will be absolutely crucial. I will stop there. Thank you, Nadia.
So interesting. And do you feel in your position the momentum right now, do you feel it's greater than it's been before in your career, or how do you see, you're just talking there about the international community and so forth. Is there more momentum around this now than you'd seen before?
I definitely think so. When I started work on these issues back in 2016, it was really considered a niche issue and a very much a European issue, and not even a whole of Europe issue, but the issue which there was interest in some in the Nordics, in particular, the Netherlands, maybe in some others. And I think it's been phenomenal to see how this has really gone mainstream. I also think, and that I was reflecting when I was listening to Jamie's responses in terms of how do you get the business community to follow, which of course is absolutely crucial. My sense is that in the European Union, we have to a large extent actually done that journey. If we look at the financial sector today, they are much, much more involved in this issue, much more interested. It's basically no longer a question of if, but rather on how. And of course, that is where we need the tools as the taxonomy, we need the disclosures, we need the green labels to basically help the corporate sector to help themselves to a certain extent and to help all of us.
So disclosure, taxonomy, green bonds, the actual strategy, sustainable finance strategy, all key. I might just ask you one question before we run out of time for this session and before we go to some audience questions, which are piling up. So it's great to see everyone so engaged. What do you see, Paulina, as the implications to the Australian finance and business sector from that EU approach we were just talking about?
Well, I think as others have mentioned, I think it was Alex who mentioned that, I mean, financial markets are of course global today. Well, they've been for a while, by the way. And I think a lot of companies, a lot of investors, first of all, they have a global business themselves, and they're also looking to invest not only within their own countries, but also globally. So from that point of view, I think the standards that we are trying to set in Europe, or in a certain extent, the advance that we have in Europe, I assume that is of interest to Australian business community and investor community as well. Now, of course, there are regional differences, and that's why I also think that it's very important to work with the stakeholders, to work with business. What we have done in Europe is that we have a platform with experts that help us, notably in the development of the taxonomy, precisely because we know that we as policymakers do not ourselves have all the answers, and I think we need to have this very inclusive process with all stakeholders, precisely to make sure that people feel that this is relevant and that they can come along with it. I will stop there.
Yeah, no, that was great. Just finding the unmute. That was great to hear from you and really valuable for everyone in the audience. We have got quite a lot of messages, so we'll quite a lot of questions rather. So we might start with this one. So I don't think this has been directed at anyone in particular. So out of, the panelists, feel free to jump in. What are your perspectives on, and maybe each panelist can give their take on this. What are your perspectives on how we bridge the gap between the level of ambition needed to meet the objectives of Paris and what is politically palatable domestically in many countries? Anyone feel free to take it away, or we can go in the order, maybe starting with Louise.
Sorry, I was finding the unmute button. I've got two computers. I think what Paulina has mentioned previously is that international collaboration is key to this, and working with like-minded countries to bring those policies in is key. But also, from quite a lot of my experience in my sort of trade role, I see that a lot of businesses are actually more forward-thinking than their governments, and I think also using businesses as using the voice of business as well is pretty key. Thanks.
Yeah, indeed. And Jamie or Paulina, also feel free to jump in with your thoughts, so your answer to that question as well, if you like.
Yeah, I mean, look, frankly, the question probably touches on the challenge that you face about delivering any sort of, ambitious agenda on a complex problem, whether it's around nuclear disarmament, whether it's around climate change, whether it's around environment biodiversity. And you've got this challenge about how do you try and keep, under the Paris Agreement, all parties together in a way that can deliver what's needed in that collective effort and prevent the splintering of elements, but also how do you ensure that you're not sort of always held back by the sort of lowest common denominator? And we've seen, the challenges of going from the Kyoto into Copenhagen, into Cancun, and then into the Paris Agreement, which is very much a bottom-up, consensus-driven process, and that has its strengths and weaknesses. But its biggest strength, I think, comes in actually the transparency, peer accountability, and pressure that's put on, and that I think we've seen that, and with Glasgow, and in terms of looking at what countries not only have committed to on targets, but what are they doing, and what's their track record look like, and how does that stand up against others? And I think that pressure is something that is critical in any sort of international mechanism to deliver to an international problem or solution. But the other part of it, I think, is very much on the carrot side of it. How do you incentivise, as has been mentioned by both Louisa and Paulina, that international partnership and collaboration, and not only sort of how do you look at how like-mindeds can work together, but how do you identify the partnerships that are going to come from countries that have different perspectives and experiences. And I think that's one of the benefits of the US-China agreement. It's partly, you know, where Australia is looking at how we're reaching out and engaging with other countries. I've seen some of the questions around, you know, well, how do you do this without a price on carbon? And obviously there's a lot of history and politics around this, but what needs to be done is to say, well, what are we committed to trying to achieve here in terms of greater ambition and achieving emission reductions? How do we bring the strengths of different countries together to try and really hold each other accountable and deliver that action going forward? And if we don't have that, the risk is it becomes fragmented and you fall back into a very sort of national and sovereign-driven approach, which we just know in terms of addressing the climate situation is not going to be the best outcome. But yeah, anyway, I'll stop there. Thanks.
No,
yeah,
if I may, yeah.
Go ahead. Yeah.
Yeah, no, just very briefly, I think I see three elements. One is the international cooperation that both Louise and Jamie have referred to. I mean, absolutely, the more we can have, if not common, at least interoperable approaches globally, of course, the least you get the problem of people feeling a, let's say, first mover disadvantage. I think that's important. I think the second issue is what I mentioned already in terms of making sure that this transition can be inclusive. I think it's absolutely crucial to get everyone on board, small companies, citizens in general. And then the third remark, and I think that Louise may have said something slightly similar, is that I don't think we should see it as a contradiction. I don't think there's a contradiction between wanting to do the right thing for the climate and what companies want to do, because I think at least in the European Union you see increasingly, and actually I would say almost everyone, that, you know, companies are fully on board on this, and they are in some areas actually going further than the policymakers. So I think that this is, I think, a bit of an outdated contradiction, this idea that doing things for the climate would be something that is not in the business interest. Also, obviously, everyone who thinks long term will be, you know, it's evident that you then need to take the climate change consideration into account, and, you know, not only for the sake of the planet, but actually for the sake of your own profits and your own business as well. Thank you.
Thank you so much, and thank you to all of our panelists. Some really interesting insights in that session, and, you know, very lucky to have you all with us for this event. So thank you once again for your time and your insights. We'll move now to our next panel session, where we're going to hear the perspectives of the Australian finance and business sector. So I'd like to welcome Kylie McFarlane, the Chief Operating Officer of the Insurance Council of Australia, Louise Davidson, the Chief Executive Officer of the Australian Council of Superannuation Investors, and David Jenkins, the Global Head of Sustainable Finance at NAB. So thank you all so much for being here and sharing your knowledge and insights. And I think we'll start with Louise. Everyone will be very interested, I think, in hearing some insights from your position. The formation of an International Sustainability Standards Board, which we've heard a bit about so far today, that was announced at COP26. It would be great to hear from you a little bit more about the announcement and what it means for Australian investors.
Yes, thanks, Nadia, and hi everyone. It's great to be here, and what a great panel that last panel was, in terms of giving us some of the inside detail on what happened at COP. So I think in terms of the ISSB, COP26 certainly increased the focus on the need for greater transparency and disclosure of climate risk and strategies and the progress that's being made. And from our perspective, our members are investors. They invest across the entire economy. They invest in a lot of listed companies, and it's really important for them to be able to play a role in holding companies to account on their climate aspirations, to ensure that what they're saying they're doing is what they're doing. And so the launch of the ISSB is a really positive development, we think, because, I mean, obviously we're talking about climate here, but it will go further than climate, but it will really strengthen, I think, that reporting on ESG issues, and will provide global benchmarking and streamlined frameworks that will then make it easier for investors to better assess how well companies are tracking against the commitments that they've made. So I think one of the things that I would say is that investors really value the level of consistency in the overarching framework that will be developed through the ISSB, rather than different frameworks for different jurisdictions. And I know that there was quite a lot of concern that we might end up with a fragmented climate reporting process in different jurisdictions. And given that our members invest globally, and a lot of Australian companies operate globally, having that international consistency, I think, is really difficult. It is really important. The other thing I'll say is that having the ISSB work alongside the International Accounting Standards Board, I think will really provide that rigour and credibility to the sustainability data that is produced as part of that framework. So I might leave it there in the interest of time, Nadia, but happy to come back to that if there are further questions on that.
Yeah, thank you. And we'll definitely circle back to some more audience questions at the end of this panel discussion. So if anyone has any finer points they wanted details on, please do send in your questions. Now, Louise, I guess turning to another issue, I understand the Australian Council of Superannuation Investors has recently released research on TCFD climate disclosure reporting by ASX 200 companies. It'd be interesting to hear your perspective on TCFD reporting in Australia and how companies are integrating climate considerations into strategy and reporting. It's a bit of a common theme that we're hearing tonight about that importance of integrating this into your day-to-day operations. So yeah, that would be interesting to hear.
Yeah, so our expectation, I think, is that the TCFD framework will feed into the work that the ISSB does, and that the first standard that they release will be a climate one. And so so it's interesting to think about what has changed in Australia over the last 18 months in respect to climate reporting. And we know that the debate is shifting quickly, that there's a lot of momentum behind all of this. And part of that, I think, is the increase that we've seen on the TCFD reporting. From an investor perspective, this is something that we've been really encouraging companies, particularly those that have a climate exposure, strong climate exposure, but others as well, to move quickly to producing TCFD framework type of reporting. And you've seen quite a few jurisdictions around the world are moving to mandating that reporting. And I would say that from an investor perspective, it really helps us to make sure that companies are making appropriate commitments, that they are really carefully thinking about the path forward for them in a low carbon or no carbon future, and how are they going to make that transition. The issue of transition was mentioned in the last panel, and I mean that's a really critical issue, I think, for us. In order to actually get to where we need to go, we must focus on the transition, and we can't only focus on 2050, we have to be looking closer than that. But in terms of the disclosures that companies in Australia are making, that has really, in terms of TCFD adoption, that's gone really gangbusters, I would say, over recent times. So we've done a recent study that looked at the disclosures that companies were making as at 31 March of this year. And there are 80 ASX 200 companies that have adopted the TCFD now, which has been a really significant uplift. We think that the majority of ASX 200 companies will be expected by investors and civil society to be using TCFD by next year. And so obviously we'll be continuing to track that. And also I hope to be having some input into the development of, how that moves across into the ISSB. So I think I might leave it there because I know that we're quite tight for time, and happy to come back if there are further issues to be explored there, Nadia.
Yeah, thank you so much, Louise. That was really great to have you with us and get that insight from your industry, and interesting to hear the majority using TCFD reporting by next year. We might turn to David now, and great to have you with us. really interested in hearing from you with your wealth of experience in this space about one major outcome of COP, the finalisation of rules around Article 6 of the Paris Agreement, the rules to enable international carbon trading. Could you please provide some more detail on this outcome and what it means for Australian business and the finance sector? Now, I think your mic is on mute, so just, perfect.
Is that better? Sorry about that.
That's great.
So I think everyone knows that close to 200 nations agreed on the outcomes at COP, including Article 6. And these actually can cover national country contributions, so NDCs, as well as cross-border compliance markets. In terms of the opportunity, what we're seeing in Australia and what we're seeing globally is a significant uptick in demand for voluntary carbon credits, and the scale of trading and volume in the last 8 months apparently has far surpassed what happened in the previous 12 months globally, we understand. If you look at Australia, it's clear to see that there's been significant uncertainty from some in the agricultural sector and farming sector around carbon pricing and the value of those carbon credits. This will bring a lot more disclosure, a lot more rigor to how voluntary carbon credits are traded, priced. They'll create an international framework for doing so, but they'll allow countries that have already met their climate targets to trade those offsets in the international market and avoid the issue of double counting. That's one of the big concerns, and it doesn't take much to scratch the surface and realise there is a lot of debate around the quality of some carbon credits. And again, where they've come from, how they've been used, are they in fact high quality carbon credits, and or are they credits that have been derived from avoided emissions versus carbon sequestration, et cetera, The other thing is there are specific industries where they will need carbon credits for the foreseeable future as they transition. If you think about the global aviation industry, quite clearly, there's no immediate alternative. They need a transition pathway, the use of carbon offsets until there's a material and credible alternative, whether it be the use of biofuels, battery-powered technology. They will continue to play a very large part. There's a global offsetting system in place for the airline industry. This system will bring a lot more rigor to that and support a lot more growth in the generation of carbon farmings and provide new revenue streams for much of our agricultural sector, we would hope.
Yeah, excellent. I think, I'm seeing some questions come in for you, so we'll probably follow up on that more with some audience questions shortly. But I might just ask Kylie now, a lot of these issues obviously key to your industry too. What, if I could ask you, what the growing climate risk means for insurance availability and indeed affordability in Australia?
Yeah, thank you, and thank you to Louise and David for their comments as well. Yeah, I think ultimately many people see insurance as a given, not only here in Australia but globally as well, and an expectation that if I have an asset, it will be insured. But really the pertinent question is what happens when it's no longer available, that insurance is no longer available, or it's too expensive to purchase. And I think for insurers to continue to provide insurance coverage at affordable pricing, we're going to have to see action to strengthen the resilience of our built environment here domestically and see Australia's economic transition to net zero happen at pace. Now, I say that at present, no region in Australia is uninsurable. However, as the risk grows, it is possible that some regions may become difficult to insure. And it's also already a case that insurance premiums are quite expensive in areas where there are known severe weather hazards. Climate change is obviously part of this mix. It's driving the increase in the frequency and severity of extreme weather events. The impact of these events may influence the future affordability and availability of insurance in Australia, without a doubt. And I think we only have to look at the last 3 years to really understand the devastation that natural disasters can cause. In that 3-year period alone, insurers have paid out nearly $9 billion in natural disaster claims, with more than $6 billion of that being paid out since the 2019-2020 bushfires. So these significant events, which are happening more and more frequently, is seeing this constant reinvestment in the economy in rebuilding and recovery, as opposed to mitigation and adaptation. And certainly, you know, addressing climate change, the driver of these worsening extreme weather events in Australia, is critical to addressing the challenge. We've always had natural disasters in Australia, but they are increasing in frequency and in impact. And it's going to require investment not just across all levels of government, but also across industry as well, including the insurance industry. We all have a role to play, as Louise has just talked to as well, around the transition. And we do need to keep our eye on that prize around 2050. But these transitions are also coupled with those practical physical adaptation and policy requirements as well. Things like stronger building codes, improved land use planning, and permanent physical mitigation measures. And for those people living in Sydney and potentially on the northern beaches in Sydney, they will have just seen the completion of the Collaroy seawall as a very clear and obvious physical mitigation measure. All of those will be necessary to ensuring Australia continues to be an insurable country, both for our homeowners, our small business owners, and also more broadly economically. For the ICA, we're obviously committed to providing support and guidance to our members to build that knowledge and do the research and share best practices around climate action, because we don't see a future where we have an uninsurable Australia. That is not an economic outcome anybody wants. So we do need to use both our voice and our ability to advocate for the need for resilience and mitigation investment to ensure insurability of our assets going forward.
Yeah, so interesting hearing from you, Carly. Your industry is obviously so closely affected by all these climate issues. The sort of natural disasters of the past few years of the massive fires, floods, and so forth that Australia is often affected by come to mind. Often on the front line of these extreme weather events, which we're seeing increasing in severity and frequency. What role can the insurance sector play in actually building our resilience to these events?
Well, I guess our biggest role is we price risk, right? So actually we become an indicator of that risk, not only for business owners and for homeowners, but also for governments and for industry. When we price that risk, we're sending a signal to the market about the risk of an event or events to that asset that is looking for coverage. However, we also have a very big role to play in partnering both across industry and with government on those efforts that could be put into place to ensure that we mitigate some of these issues. Part of that is around public and private investment. Part of it is about improving building standards and quality. And another part is about making informed land use planning decisions. To put that into perspective, the Australian Business Roundtable for Disaster Resilience and Safer Communities estimated in their 2021 report that natural disasters are currently costing Australia $38 billion a year, so approximately 2% of GDP. And that will increase to $73 billion a year by 2060 under a low emissions scenario. So it's important to note, under a high emissions scenario, that increases to $94 billion per year. Now, this increase in cost isn't just attributable to climate change, it's also attributable to population growth and growing property value. But it is important to note that climate change is one of those three key indicators. And a real key point here is that the Productivity Commissioner in their work has actually estimated that 97% of all natural disaster funding in Australia is actually spent after the event. So it's spent on response and recovery, with only 3% spent prior to the event to mitigate against that event actually happening in the first place. And we literally have to flip that scenario. We're really pleased to see the recent public expenditure announcements by federal government through the National Resilience and Recovery Agency begin to redress this imbalance. However, we need to see more. And increased investment in adaptation and mitigation has got to be a hallmark of every government in Australia from now on. That, coupled with the implementation of stronger building codes, we are lobbying and advocating for having resilience codified in the National Construction Code in this country, ensuring improved land use planning decisions are made, and as I mentioned before, that those permanent physical mitigation measures are put in place where necessary. All of those things, all of those factors assist in building a more resilient country. The other part of that obviously is reducing emissions to reduce the severity and frequency of the events that in fact cause the most damage. So I guess we've already got a lot of examples of what's happening. The importance of this is really going to be partnership, partnering with government, partnering across industry, and ensuring there's a clear use case for investment, both publicly and privately, into mitigation and adaptation. And part of that all becomes a part of the economic transition to net zero by 2050.
Very interesting, and quite incredible to hear that financial toll of our natural disasters spelt out. One final question for you before we head to some audience questions and circle back to David. We've got a question lined up. So Kylie, as the insurance sector looks to transition to net zero, how can the industry go about reducing emissions when it comes to underwriting and supply chain?
Yeah, such a good question. And, as we look into the transition, as we think about the role insurers play in transitioning to net zero by 2050, those scope 3 emissions around supply chain and underwriting are the biggest challenge for us. It's why alliances like the Net Zero Insurance Alliance are going to be critical to aiding the development of global standards. And while, Swiss Re made the point at COP26 that when it comes to credibility and successful implementation of targets, the first point is speed. We have to be speedy with methodology. We can't just drive into this problem without understanding what steps need to be taken. And when those steps are taken, being able to review and consider whether or not we need to be agile and dynamic in how we continue to move forward. This is a conversation that's not just happening domestically, it's happening globally. All insurers and reinsurers are considering this issue around supply chain and underwriting. And it will be an important part of our transition roadmap, both domestically and globally, as we start to unpick how we start to address supply chain and underwriting emissions between now and 2050.
Indeed, thank you so much, thanks to Louise, David, and Kylie. It's been really wonderful to have your expertise and knowledge as part of this panel. So valuable and vital for this. We will now turn to some questions. We've got quite a few from the audience, so we'll try to get through as many as possible. The first one is for David. What, if any, definitions are there for high quality carbon credits?
I'll have a crack at this, but I'll be quick to admit I'm no carbon market expert. But here in Australia, certainly from the eye of a participant in the markets as a bank, the Australian ACCU, so the Australian Carbon Credit Unit, is widely traded and is well understood and part of both the compliance and voluntary markets here in Australia. Now that is actively traded. There's an observable price. And the actual projects which it supports and the basis on which it's accredited is clear, transparent and well understood. Most of the larger high-profile Australian corporates will seek to acquire ACCUs to offset their net emissions. In comparison, some of the offshore carbon markets tend to have a myriad of different compliance and voluntary schemes, and I think this is where Article 6 will come to play, creating consistency across international borders, creating comparability between standards, and providing more transparency around where they're coming in. Are they avoided emissions credits? Are they carbon sequestration? Where the greatest decarbonisation impact is. So in its simplest form, and this is my uneducated view, I'd suggest, is the greatest decarbonisation impact is really where the highest value or the highest quality offsets would come from.
Excellent. Thank you for that. Thank you for that answer. A question here for Louise from an anonymous attendee. You talked about ASX 200 companies taking up reporting against the TCFD. From the reports you've seen so far, what exactly needs to be improved?
Well, good question. I mean, I guess we have some tolerance for the fact that this is an iterative process, okay? And so, once companies have to make a start somewhere, and this can be challenging depending on what industry companies are in and so on. But I think it's fair to say that one of the areas that has been of most concern to us has been in the extent to which the scenarios that companies choose for their modelling are credible. And so we did have concerns at one point. I think this is improving, by the way, but we did have concerns at one point about too many scenarios, which meant that business as usual was going to be fine. And, that companies were going to be able to just keep doing what they were doing because they'd modelled it and it was all okay. So really what we want to see is we really want to see that companies have been really thoughtful and modelled all the different parts of their portfolio, because let's face it, a lot of companies have, quite broad portfolios of activity against credible scenarios and have really thought through what impacts there are going to be. And, what does that then strategically mean for them as an organisation? The other thing that we do want to see is a link, like we really want to see that then feed through into financial statements. So if there's going to be X dollars having to be paid for transition, if there's going to be assets that are going to have to be retired, we want to make sure that that is reflected in financial statements, and so that the climate reporting does not sit off in some kind of separate little file that's not linked to the intrinsic future of the company.
I have another question here that's a bit broader, sort of big picture for any of our panel to answer. What new skills and training will be needed for companies to manage climate-related risks and reporting, to scale and bring rigour to ESG or sustainable finance, etc.? Anyone of the panel, feel free to jump in and give your views on that.
I might just speak really quickly to this, and I'll just say one thing to be wary of is that there is quite a high demand for ESG practitioners at the moment, and that's causing a lot of organisations some challenge. But look, the thing is that it's just really important for companies to build this capability, and often it will be the people who know the business who then need to educate themselves or bring in some resource to help them understand what the implications for their business are. I mean, that goes for investors as well as for companies, of course, but the other panelists might have some more specific suggestions to make.
Yeah, I think that's a really good point, Louise, and you're so right about the demand for ESG professionals. It's extraordinary, and for those ESG professionals who have climate experience, that's even another level of demand. And I agree with your comment around them coming from within the organisation. Unfortunately, there isn't a ready-made plethora of ESG experts out there. And so we are going to have to build our own. And they exist. Quite often they're your risk professionals or your governance professionals or your stress testing and modelling professionals who actually have an interest in the topic but have never been able to explore that as part of their professional duties, whereas now it's a key component of their professional duties going forward. So they become part of the transition. Transitioning your workforce to actually understand those new requirements is no different to what you would do if you were implementing a new product design or bringing a new line of business into your organisation. It's not without its challenges, but it is probably the only way to make sure you get the quantity and quality of resource that you're looking for. And then to Louise's other point, it's going to be really important in the early days to use those external parties, whether they're consultants or agencies or others, to come in and assist with those early modelling requirements, setting up the frameworks, getting the scaffolding right. That's where the kind of initial investment needs to be. But then you should be able to transition workforce into those roles.
So I might add to that from the bank perspective. The points have been touched on quite clearly. There is no traditional pathway for sustainability professionals to come through. We're seeing now, and certainly in the sustainable finance aspect, probably the deepest skill base comes from within, people that understand the business and know how to apply through the lens of whether it be ESG risk, a risk lens, taking into effect both the risk and the opportunities that offers when considering sustainability issues. But we often see in this particular sector and within the banks, you have to be resourceful, you have to be, I guess, resilient, because there is so much happening at the moment. There is such an avalanche of things to be up the curve on. And as everyone knows, the landscape is changing almost daily. What may have been the case 6 months ago is no longer relevant in many cases. Investor expectations and demands continue to rise, justifiably so. Policy changes are happening globally. The environment within Australia, from both accessing financial markets to creating product, the risk of greenwashing, liability issues, understanding what's credible, what is best practice. I mean, it is quite a breadth of skills, and it's very difficult to find any one skill set that describes it all. But I think you'll find in most of the banks, they have quite a range within their teams that complement each other. And I think that's probably the best way to look at it, upskilling who you have, finding people that are passionate, resourceful, and can think outside the box in many cases on how to find solutions and adapt the old way to the new way, because exactly as people know, the past is no predictor of the future.
Indeed, and that sounds like a very good note to wrap things up on. We're actually finishing not a second over time, so thank you all again so much for your time and valuable insights today. And I might hand over now to Christy to wrap things up and to finalise today's event. So thank you all to all the panelists and everyone for listening in the audience.
Thanks, Nadia. And it's been an incredibly rich discussion tonight. Thank you all the panelists for all your contributions, and Nadia for facilitating a really engaging and informative discussion. So thank you. We heard right from the beginning, kicking off with Alex Heath from the RBA. She gave us a great introduction explaining how financial regulators are considering climate change and the impact that will have on Australia's financial system, how they're building on international work in this area and really adapting that to the Australian context. We then had in our first panel some really interesting beyond the headlines insights from COP and the journey forward from here. Louise touched on the major and lesser known achievements of COP and how the momentum on climate finance in particular can really be translated outside the COP context. From Jamie Isbister, we heard on the key developments around international carbon markets and particularly how the Australian government's now working with partners in the region to accelerate clean energy transition beyond our borders. And then Paulina on the leadership role the EU is playing in sustainable finance, not just in Europe, but globally, and what we can learn from their experience there to adopt and adapt here in Australia. We then had a stellar lineup from across the finance sector in Australia with Louise, David and Kylie, and discussions were really broad-ranging, new developments on sustainability reporting and disclosures, where carbon markets are heading and the role the insurance industry is playing in building resilience and reducing emissions, and finally kind of their views on how the sector can move forward and the skills and capability and adaptability that's really needed to support the transition. So a huge thank you again to all the panellists for your contributions, again to Nadia for so very capably moderating, and thank you to all the audience for being really engaged. There was a lot of questions, a lot of things going on in the chat. So thank you very much for playing such an engaging role in the conversation as well. Look forward to seeing you all at another ASFI event soon. Thank you.